Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. In the latest edition of the Moneymakers Investment Trust podcast, I'm very happy to be joined today by Tom Treanor and Charlotte Cuthbertson, who are the co-managers of the MIGO Opportunities Trust. This one has been a regular podcast for us because it obviously is of interest to our listeners in that your main function is to scan the investment trust universe and look for opportunities, particularly discount opportunities that may or may not be out there. So obviously, Tom and Charlotte, you've been co-managers of this trust since June when Nick Greenwood stepped down, and there have been a number of changes since in the way that the trust operates. So why don't we start there before we dive into the many interesting opportunities out there, just to give us a quick summary of the changes and how far you got with the process.
Great. Well, thank you, Jonathan, and we're delighted to be here today. So as you say, there's been a few changes to MIGO, and we've sort of split them out into how we run the portfolio and then also on the corporate side. So I think I will let Tom chat a little bit about what we've done on the portfolio side and how we've adapted the mandate, and then I will take through a couple of corporate changes.
Thanks, Charlotte. Hi, Jonathan. So as Charlotte says, you can divide the changes into two very broad categories. The investment strategy changes, which are very much a revision rather than a wholesale change to the approach. The approach is still very much investing in predominantly London-listed closed-end funds, known as investment trusts, at discounts to NAV, and looking for a catalyst for that discount to narrow. Now, when I took over from Nick in June 2025, became co-manager with Charlotte, we really felt it was an opportune time to examine what we could do better and differently on the fund to perhaps make it a bit more suited to the current market environment that we're in. The first of those really is about reducing the number of holdings and increasing the concentration in the portfolio. That's for a few reasons. One, it's how we like to run money. Two, we think that the fewer holdings you have, the better you can know each of those holdings. And thirdly, and I guess this really leads on to the second change, the fewer holdings you have, the more likely you are to have a larger stake in those holdings. And that gives you a bit more clout at the table when engaging with boards and managers about ways to eradicate or narrow discounts to NAV. In terms of progress on that transition, to go back a year and a bit ago, we were at maybe 55 holdings or so. We are down to 32, 33 today. The top 10 is now almost 60% of NAV, up from around 40 going back a year ago. So very good progress there. And then behind the scenes, we have been engaging very proactively and extensively across the portfolio in both existing names and those that have come into what we're calling MIGO 2.0 as well. Another change, it's really a function in part of the opportunity set, is to decrease the exposure to listed equity positions. And obviously, every investment trust we invest in is itself listed. If you look through to the assets, I think the look for equity exposure now is no more than maybe 5% of NAV. A big reason for that is about value and where the opportunities are right now. Clearly, you've had SARB being very active, particularly in the listed equity space. Discounts have come in a long, long way. And because of that, the average discount on the conventional or equity trusts is now sub 10%. Secondly, apart from just opportunity set and the value on offering, it's about where we can add the most value for our holders as well. The NAV is the NAV for the most part on a listed equity trust. It's mark to market, you have live prices there. There's a whole additional analytical lens that you need to look through unlisted assets with. And so a lot of our time is spent trying to verify and validate how credible reported NAVs are, applying our own adjustments, looking at the inputs to valuation approach, etc., looking at third-party comps, speaking with expert networks, and so on and so forth. So that really covers the investment strategy changes, and Charlotte can comment in a lot more detail on the corporate shifts we made as well.
Yeah, so I mean, I think that when we looked at the corporate side, I think we were looking at it through that lens of what tweaks can we make to make this the right product for the current time, and how can we most align ourselves with shareholders. And I think that was the part that we really had as a front of mind, was how can we make sure that when shareholders get good returns, we're aligned with that. We didn't want to get paid for just asset gathering. We wanted to get paid for performance. So on that vein, we have nearly halved our management fee. It's down to 35 bips from 65 bips. But the quid pro quo is that we have introduced a performance fee. So that is returns in excess of SONIA plus 3%. So that's 15% of returns above that hurdle, which is higher than our benchmark, because, we wanted proper performance rather than just narrowly being the benchmark. We thought that it would be important to make that hurdle higher. We have capped that fee, and we have said that we will reinvest 25% of that fee in MIGO shares. So it's really creating that alignment, as I said. And then on the other side, I think this is very much going against the grain of necessarily what we're seeing in the investment trust world, where size seems to be the all-important factor. Larger and larger trusts is where we've been going over the last few years. But again, it's having that eye on performance, and it's having that eye on returns for our shareholders. And we think when you're investing in the investment trust sector, size can actually be an enemy, because liquidity is pretty poor. And there are a lot of trusts below that sort of 500 million market cap. And often they're an area where you find a huge amount of value. And so we've also brought in a capital redemption policy, where if the NAV gets over 150 million, at the director's discretion, we will return capital to shareholders. And that's really to keep us nimble and able to invest all the way across the market cap spectrum. So that, I think, as I said, one of the biggest problems with investing in illiquid assets is you get too big, and it's a bit like turning a tanker. We want to be nimble, opportunistic, and find the best returns.
Okay, so there's lots to unpack there. Let me just start with one then. Obviously, there's a widespread view, I'm not saying that I share it, but there's a widespread view that the future lies in large liquid trusts. So what you're implying is that there's still going to be opportunities down at a much smaller scale. Presumably, you're hoping that they're going to persist for some time. Otherwise, you'll be putting yourself out of business, right? If you can't find a lot of small liquid trusts out there, if they've all gone to the wall. So do you think that that kind of narrative is not entirely correct? That it's only the large liquid ones that are going to survive?
I think ultimately what we will see is probably a bifurcation of the market. So we will see trusts at the larger end getting larger, because they need the liquidity for wealth managers that are getting ever larger. On the other side of it, though, there is always going to be a place for smaller trusts who are invested in illiquid asset classes on doing something very, very different. And I think that's the thing with a trust, is it no longer can have a very generalist sort of equity portfolio. You need to be doing something different and using the investment trust structure to attract buyers. So we think that there'll always be a place for UK microcap trusts, for example, because the liquidity is so poor there, that running it in an investment trust structure, we think, is the best kind of structure. So we do think that eventually, further down the line, so in a few years' time, that's probably where we'll end up. But if we look at the opportunity set between sort of the next, say, 2, 3, 4 years, the opportunity set really comes from getting the supply and demand back into equilibrium in the investment trust market. We had 15 years of issuance. So there's still too many trusts, too much capital in the investment trust market for the amount of buyers. And we think that's where the opportunity set will be for the next, we would say, 3 years.
Right. So in other words, the nature of the game is changing somewhat, and has changed for all the reasons that we've documented. Now, obviously, MIGO now part of the Asset Value Investors stable, where you have a much bigger trust, AVI Global, which deals with larger trusts. So what is the rationale, if you like? What are you saying to potential shareholders? You've put a cap on the size of the trust, but what are you saying? What kind of people are you trying to attract? And what is the benefit of having a holding in something like MIGO Opportunities? I mean, is it ever going to be more than make a marginal contribution to people's portfolios?
What we would say is that I think it's now almost universally accepted that we are in a particularly narrow market by historical standards. You have not only broad indices being essentially a bet on the US, within that, they are a bet on US tech, And within that, they're becoming increasingly a bet on AI. And will there be an acceptable return on investment from the ginormous sums being invested into AI capex? Now, we think that MIGO's return profile should offer something very much uncorrelated to that, and as such, merits a place in investors' portfolio. I think if you look at the return profile you're likely to see on MIGO, and if you look at our top 10 holdings, many of those are vehicles in runoff. And what you know there for a fact is that a discount is definitely going to zero over a period of time. The key question, of course, is how much of that is the NAV coming down to meet the share price, and how much the share price coming up to meet the NAV. Now, a lot of our time and work is spent on trying to sift away the dross there and work out where NAVs are credible and where they offer us a suitably asymmetric return profile from here. So looking for a situation where in the downside scenario, where we're building quite a large margin of safety, we'll probably wash our face. We might lose a little bit, we might make a little bit, might end up breaking even, but we're not going to lose any material amount of money there at all. Then in our base case or blue sky scenario, we're looking at 20% IRRs upwards from there. So what that should mean is that our returns are very much dependent on things like, has GCP asset-backed income had a loan repaid or not? We very much rely on events like that moving the NAV needle for us than we are whether NVIDIA has beaten its quarterly earnings or not. So we think given all of that it has got a very valuable place in a broader portfolio.
MIGO Opportunities has always been very popular with private investors in particular. Typically has traded pretty close to par a lot of the time, which is impressive, allowed you to occasionally to issue some shares. So is part of this story that you're putting forward the fact that you can do the kind of detailed work that perhaps most retail investors aren't either perhaps qualified or capable of doing, or don't have the time to do, or if they have the time, they don't have the skill set? So we're talking about some quite complicated things here in terms of deconstructing the models of alternative asset trusts in particular.
Yeah, exactly. I mean, you've hit the nail on the head there. We look at trusts all day, every day, and are very close to the market. And we do a huge amount of work on the underlying portfolios. So we have, access, as Tom said, I think at the outset, to expert networks. We do quite a lot of detailed scenario analysis, IRR scenario analysis. And I think that's why people like using MIGO as an outsourcing vehicle. It's quite clear there's an awful lot of discounts throughout the investment trust sector, but not all discounts are made equal, and not all NAVs are made equal. And that's where the opportunity lies, but also the risk. And so outsourcing to myself and Tom, who are hopefully the experts in our field, means that hopefully you can sleep a bit better at night.
Can you give us a couple of examples of things that have already worked out for you? I'll make it easy by saying start with the ones that really worked out for you. Obviously, there have been trusts which have delisted, so something like Miton UK Microcap, that would be one that's, if you were, disappeared, and presumably you made a bit of money out of that one. I hope you did. Take that one first, and then we'll talk about some other examples in the alternatives. That was obviously in the equity space.
Yeah, so Miton UK Microcap, that disappeared, I think, last year. And the thesis behind that was that the UK was undervalued, and then microcap stocks were undervalued in comparison to large cap UK, and then you could buy investment trusts on a discount. So you had what we would describe as a Russian dollar discounts in that situation. And for that one, it was part of a basket of UK microcap. And because the trust was trading at a discount to net asset value and had a yearly tender, the assets were getting smaller and smaller and smaller as people redeemed in that yearly tender. And so unfortunately that trust was wound up. But I think in terms of what we would say is more of the MIGO 2.0, more of the opportunity set and things that have worked for us more recently. Maybe Tom, do you want to take?
Yeah, I mean, I'd say something like PRS REIT has been the top 5 holding, probably top 3 holding for the best part of a year or so. PRS REIT was the largest owner in the private rental sector in the UK, the owner of 6,000 homes, had traded for a long time at persistent discount to NAV. Part of that was due to governance concerns and a perception that the board was perhaps too close to the manager. There was a requisition by a disgruntled group of shareholders. We were happy to back that. And that led to Rob Naylor joining the board of that company would have been Q4 24 now. The board did a strategic review, the outcome of which was to engage in a formal sale process for the portfolio. And while it took far longer than we would have liked it to have taken, the outcome was very, very good for MIGO, and the IRR there, I believe, was in excess of 25% in the end.
Indeed, and I was a shareholder in that one and benefited from that, so that was very helpful. But that was clearly a case of governance issues, as you said, and that was one where you felt you had to go public, or at least the group of aggrieved shareholders did go public at one point. But you say that's not your normal style. Can you give us another example where you've actually achieved something behind closed doors that perhaps was not evident immediately to outsiders?
There are many examples in the closed-end sleeve of the AGT portfolio. I would say that the activism and engagement side of things is obviously a newer thing with MIGO from June of this year onwards, really. Although having said that, there are a couple of examples further down the portfolio. I think by their very nature, they were private discussions, but there have been examples of board changes that exist in holdings in MIGO, but we play quite an important role behind the scenes there.
Right. Well, can I just take one current example? I'm interested in your thoughts on this. I'm sure other listeners will be interested as well. Where it seems to have had a little bit of a setback, and that is SDCL Efficiency Income. You had a position in that, and they've come out recently with an announcement that's disappointed the market. Can you tell us what you think is going on there, and what lessons, if any, are going to be drawn from that? Is that something where the market just basically got it wrong, or was there something less innocent than that?
So whether we're lucky or smart, I'll leave you to be the judge, Jonathan, but we actually sold a very large portion of that holding. We bought it very, very well back in March 25 or so, become an outsized part of the portfolio by the end of October or so. We felt returns were less attractive going forward, and there's obviously a very rich universe at the moment, but we sold over 2/3 of our holding ahead of yesterday's announcement and the near 20% fall in the share price. So we were spared the worst of that, certainly, which is comforting. But in terms of what happened there, I think what it shows you very painfully, I think, for the company and shareholders is the aversion the market has to any sense that there may be balance sheet stress at a company. I think memories of DGI 9 are still very much warm in people's memories. I think people have seen what can happen when you have a very stretched balance sheet. And there were a few people, I think, trying to draw some parallels yesterday between the situation that DGI 9 faced and SEIT is facing. I can see the superficial appeal there. I mean, what you have is a NAV that is calculated in part on the assumption that they can fund a growth capex spend, and that certainly applies to both of the companies. Secondly, you have dividend cover not being particularly high. And then thirdly, you have high leverage as well. And I think if we pick those apart in turn, and with the caveat, we are still updating our numbers on SEIT here. I think what I'd say is that when you look at the proportion of NAV that includes assumptions that are predicated on growth capex being available to the company, if they were to basically shut off the taps there, you take about 6p off the 87p NAV. Share price today is around 53p or so. So it'll be a painful hit to NAV, but it certainly leaves you at a big discount to that adjusted NAV. Secondly, I think unlike DGI 9, what you have here is inherently an income producing portfolio. In the case of Digital 9, they had Arqiva, which was meant to be their income producing asset, but due to its capital structure and its balance sheet, wasn't actually able to pay any of its cash flow out as dividends at all. And you then had Verne, which is very much a capex hungry growth capital asset. So in the case of SEIT, as compared to DGI 9, you do have a high level of income there. So I think the parallels are overdone, certainly, but we certainly are not complacent about the balance sheet there.
And just to finish on that one, because you're now in this, you've got a smaller holding in it. What are you saying to the company about that, and what do you want them to do?
We've got a meeting with them in the coming weeks.
Okay, so that one's still to play out, as it were. I'm looking down your sort of top holdings as of the end of September. That's the latest ones I can see at this precise moment. I just wondered some of the things which you may have inherited, obviously, from the earlier kind of iteration of the trust, but something like Pantheon International, I think that's one that's been owned by AVI Global as well. What's the rationale for you owning it as well? How much overlap is there with what AGT is doing?
To answer the second question first, the current overlap of names is just 3 names in total: HarbourVest Global Private Equity, GCP Infrastructure, and Chrysalis. So those are the only shared names in common. As a general rule, you should expect overlap to be quite limited between the 2 vehicles. The fact is that AGT, now at £1.3 billion, is quite restricted in terms of accessing the less liquid, smaller part of the closed-end fund market. At AGT, we like to take material-sized positions. It really means we've got to be writing a minimum £35 million ticket for any holding that we have, which includes the investment trust holdings as well. And unfortunately, what that means is that it does end up ruling out some of the more interesting opportunities at the smaller end of the investment trust market. But to take Pantheon in particular, the story there is very similar to the other holding we have in the sector, which is HVPE, HarbourVest. The story there is that you have 2 vehicles that are ultra diversified fund of funds. Essentially, you can look at them as an index for PE comprised of top and second quartile managed funds. These 2 vehicles, notwithstanding recent improvement, have traded and are trading at very persistently wide discounts to NAV, both around 30% currently. And the very high level thesis there is that that isn't tenable, and that when you have a very large, active and reasonably liquid secondary market for private fund stakes, there isn't any reason in the case of Pantheon why they shouldn't be engaging in the secondary market, looking to sell some of their more highly rated fund interests at, say, a 5 to 10% discount to NAV, and using the proceeds to buy back their own stock on a 30 discount to NAV. There's a very clear arbitrage that's available to them there, and we've been urging them in private to take that.
I think it's also worth saying that for both Pantheon and HarbourVest, I think shareholders are less patient about waiting for these discounts to close organically. So I think with the example of HarbourVest in particular, that has a continuation vote next year, that helps focus the mind on narrowing that discount for shareholders and looking at these options, as Tom said, in the secondaries market, perhaps, in order to do something to manage it.
So in other words, they announced a capital allocation policy, which was welcome. I think that was generally welcome. But as you say, they're not doing enough to actually reduce the scale of the operation, perhaps for reasons one can understand, but may not admire as a shareholder rather than some with some interest in the management thereof. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Just take a general question next about the alternatives, because you say that's where you're focusing at the moment. Do you think that there's a general story that too many alternative trusts came to market, and some of them were perhaps fully loaded with debt at the time, and then found that the market closed them? I mean, how far were they culpable in coming to the market with the wrong structure, and how far has it just been the circumstance of the world has changed since they came to the investment trust world?
I think the answer is a bit of both. I think some have been unlucky and some have been poorly managed trusts and poorly thought out trusts. There has been a huge amount of issuance because for 15 years, investors were yield starved. You barely get anything from a gilt or a treasury. And if you were looking for income producing vehicles, investment trusts that were providing a 4% yield from alternative assets were gold dust. And we saw more and more trusts being launched, some of which were of more dubious quality, particularly towards the end of the cycle. And some trusts, if you launched in 2019, 2020, the issuance window closed before perhaps you got to a size that made sense for the trust. So some trusts have been not particularly good quality, but lots of it has been timing and bad luck, and a bit of perhaps not properly thinking about what the mandate would look like and what the trust would look like in a higher rate environment, because for so long that had just not been the case. And I think it probably was a bit of shock and surprise when the world changed pretty much overnight in 2022. But we think that getting supply and demand back into equilibrium, the best trusts, some will be taken out, and hopefully some of the best trusts will remain, and there'll be somewhere for investors to continue to invest going forward.
Do you think that there will be some sort of, what's the opposite of an afterglow? I'm not quite sure what an opposite of an afterglow is, but some kind of negative feeling because, rightly or wrongly, a lot of people did pile into some of these trusts and they have experienced very dramatic declines, 80, 90% in some cases. That's not perhaps a good recommendation. It's not a great help for if you're going out now to try and market things for the future. So they may have done a lot of damage whether they were innocent or not, and some of them clearly, I don't want to mention the dreaded name of Home REIT, but some of them were clearly things that should never have come to market, and that's been a blow for the sector overall.
I think there is a bit of investment trust trauma for quite a few wealth managers, whether you're in Digital Nine, Home REIT, or any of the ones that have had particularly horrible times. And as you say, probably which shouldn't have come to market.
They not only came to market, but they raised lots of money subsequently as well, the secondary issues, yeah.
Exactly. They came to market and they raised an awful lot of money. I think also what we hope is, and what we think is probably a good lesson to learn, is that due diligence on these assets is incredibly important. There was an awful lot of trusts that were launched and a 4%, a good story and a 4% yield. But what's important when you're looking at those in these trusts is lifting the lid and looking at those assumptions and thinking about, what does this trust look like in a different environment? What does this trust look like if I change all of these assumptions from what was a particularly buoyant and nice background for them? So, lots of people have lost a lot of money, but for us, this is a huge opportunity set. So we're obviously in the right place at the right time, but we can understand why those who have lost quite a lot of money don't necessarily want to be piling back into the sector.
That's completely right. I think what we're going to see is probably a lot more scrutiny applied to new issues going forward, which can only be a good thing for everyone concerned. I think that any broker out there or manager going to come to market for the first time in particular is going to realise that their product has to be best in class in terms of not only the fund management team, the board of directors, but also discount controls as well. So I think to get anything away in the next few years, it really is going to have to be a best in class product.
Right. Well, I would certainly agree with you about that. That seems certain. Can I ask you then about renewables? When I spoke to Joe Boyenfrand a few weeks ago, it was quite hard to find anything renewable in his portfolio, the AVI Global portfolio, but you've got quite a few things there. So is that because this is a different kind of opportunity? What can you tell us about how you regard the renewable sector generally? I mean, you're mainly investing in the ones that you basically want to see disappear. Is that right? I might then ask the question, well, do you think the whole sector should disappear? What's your approach to that? And where in particular do you think the renewables have gone so badly wrong that the market was slow to pick up on?
Well, look, I think we'd say it's a very accident-prone sector for a start. And for some people, that means it's become a toxic sector as well. And we really have been seeing capitulation, we think, in a lot of the share price moves. What has gone wrong with the sector? I mean, I think as a starting point, and it goes back to Charlotte's point about the good story and a 4% yield plus, it's the point that there's a lot of moving parts to these vehicles. You have power prices, you have useful life consumptions, you have inflation assumptions, you have the actual power price curves themselves as well. And I think people have been kind of shocked by the volatility there. You've seen a lot of these companies consistently underperform the generation forecast, their budgets there. And I think there is broad skepticism around them now because of that. The area or the areas that we have tried to focus on for the most part, and one exception there is BSIF, the Bluefield vehicle. That's a recent addition to the portfolio, and I'll come back to that in a bit. If you look at things like, say, VH Global Energy Infrastructure, It's not really a traditional renewables portfolio. One, it's very geographically diversified, and it's diversified by technology, diversified by operator as well. So when you have Australian solar co-located with battery storage, you have Brazilian hydro, you have Brazilian solar, you have US oil terminal storage, you have UK gas and carbon capture. So what you have there, we think, is a portfolio that in hindsight was probably never going to work in a public vehicle. But on an individual asset by asset basis, we see quite a lot of value there with a lot of transactional evidence that can back up the carrying values. So what we're trying to do there is find particular situations where they're perhaps being tarred with a broader brush for the sector.
Okay, so that's that one. What about some of the others? I mean, you mentioned at the beginning a couple. The NAVs, frankly, they are mark to model mostly, and they are pretty much what you want them to be, aren't they? Do you think that they were just over optimistic originally? Are boards qualified to assess whether they're realistic or not? That seems to be a specific issue for the renewables. What do you think about that?
I think to Tom's point, in that there are so many moving parts within these valuations. And so inflation has been stickier and interest rates have been higher than people necessarily anticipated, which has meant that discount rates have remained elevated. And to use quite a basic example, when you're looking at these net asset values, the best way to think about it is when you're looking at selling your own home or selling a flat, which I did earlier this year, and I think it's quite a useful example, is the bank has one valuation when they use a sort of discounted cash flow valuation for how much my flat is, and they base it off what I originally bought it for and do a discounted cash flow. Then you have the estate agent who has transaction evidence. They'll say, well, flats of a similar type were sold for X in the area. And then finally, once you actually come to selling it, it's what is the demand for these assets in real life? What is a person willing to pay? What does the backdrop look like for people getting mortgages and all the rest of it? It's a very sort of basic example, but it's something that you have to think about when you look at these portfolios. So if you're looking at a cash flow and a discount rate, if a lot of these renewable trusts are looking to sell assets, but the backdrop in the renewable sector, particularly in Europe, has deteriorated, certainly over the last year or so, it is very much a buyer's market. Then there's lots of assets looking to be sold and fewer buyers. That's something that we think that you need to be aware of and thinking about when you look at the valuation for these underlying portfolios.
So what are you saying to the boards of these trusts then? Are you saying if your balance sheets actually you sell some assets even if you get a lousy price for them? What are the realistic options for the boards of these trusts?
We would say that on the whole, the boards have adopted the correct playbook for this market. That playbook being to try to sell assets and in doing so validate the NAV by selling at or above carrying values. Use the proceeds to pay down expensive short-term debt if you have any, and then with the excess, buy back stock. The problem is, like a lot of good ideas, everyone's trying to do that at the same time, and it's very much a buyer's market at the moment. We have seen sales come through with some of the larger groups at premium to NAV. Sales more recently have been closer to NAV. But fundamentally, the issue is it's probably a bad time to be selling, but the capital allocation policies are the correct ones to have.
Right, so they've just got to sit it out. But how does that help you, though? That's not going to help your IRRs if it's going to take time to get to a resolution.
I think that's why we've been very, very selective in this area. You know, our renewables and energy infrastructure sector of the portfolio is very stock specific. We haven't done a sort of top down, well, renewables are looking cheap and therefore we'll buy a basket or we'll buy several of these stocks. We have very much gone case by case basis. We've looked at asset quality, we've looked at comparable transactions, and that's been the key and the basis for the analysis that we've done, rather than necessarily going wholesale into the renewable sector as a whole.
Okay, so what about consolidation? We've seen the Trig Hickle misstep. You didn't own those, I don't think, but is that an answer? Is there anything to be said for trusts getting together? I mean, tell us about Bluefield Solar, Tom. What's the story there? Would that benefit from consolidating with another trust, for example? What are the issues that one has to face?
We're not really convinced. We can see that mergers are a good thing for the sector over the long term. Does it create value for shareholders in the short to medium term to combine two funds on similar discounts? we find it hard to believe that the combined entity necessarily trades at a tighter discount there. In the case of Bluefield Solar, it was very much an opportunistic investment on our part. We saw the share price reaction to the proposed internalisation, and we took the view that the negative reaction meant the internalisation was highly unlikely to actually happen, given it's clearly unpalatable to a large part of the shareholder base. That part of the thesis proved correct, and the company has now adopted a formal sale process, and we'll see where that actually ends up. I think our view is that there doesn't seem to be much in the share price or the rating there that prices in the possibility of a successful sale. So we will see what the outcome is there. I think more broadly on consolidation, if you look at the Hickle and Trigg proposed deal, what we wouldn't want to do is try to discourage boards from thinking big picture. And we certainly encourage boards to be thinking at all times about all possible options to eliminate discounts. I think what it shows is that they're very hard to pull off, in that you need funds that, first of all, are on similar ratings if you are going to go for a NAV for NAV merger. And equally, it's very hard to see a scenario where you could have a NAV for a NAV at a discount merger. I think you always have one party there thinking that they're getting the bad end of the deal. I think it's very important, and I think what this particular deal showed as well is how important a proper consultation process is. We would argue that the share price reaction perhaps indicated there wasn't sufficient consultation to the shareholder base. And I think that whether it's a matter of reality or perception here, I think anything that gives the impression that a deal is being done to benefit the manager rather than shareholders would tend to get a poor reaction from the marketplace. So you had both funds here run by the same manager. You had what would have been a combined, I think, 11-person board afterwards. So the manager keeping their job, all the directors keeping their job. And obviously in the case of Trigg shareholders, they would have lost the right to a continuation vote next year as well.
Absolutely. And those are all specifics that people don't like. I guess my question is really kind of alluding to the fact that maybe shareholders have their kind of shibboleths that they won't allow, but basically just sitting there and hanging on might not be a better solution in the end if the problems don't ameliorate in some way.
I think what I'd say to that point is that in the same way we would encourage listed PE funds to focus on the round trip accretion, we do the same for the renewables. And what I mean by that is that, yes, you have a reported NAV, but you also don't have cash to buy back shares at a big discount to that NAV. If you can sell assets at, for the sake of argument, a 5 or 10% discount to NAV and use the proceeds to buy back shares on the round trip there, that is highly, highly accretive for shareholders. And if the renewables market doesn't pick up from where it is, but there are options there to engage in sales below reported NAV that allow them to do things like that, then that's something that we would encourage boards to do on a case-by-case basis.
Okay, so there's no absolute hard and fast there. Can I ask you about one of your larger holdings, just more specifically, is Gresham House Energy Storage, which certainly had a very dramatic decline when things turned out to be not quite the way they said they were going to be or hoped they were going to be. And that one the discount has come in there quite a lot from, it was over 50% at one point, has come into, I think, around 30. You own that one. What's your take on that one and what are you hoping to see there?
So it's a holding that we picked up in the wake of the Harmony Energy Income bid, which ultimately was bought by Foresight, who had a bidding war with Drax for the asset. When you apply the bid metrics that Harmony went for to Grid's portfolio, you get a lot of backup for the reported NAV. It's an interesting case, actually, Grid, in that I think people think that value players and engagement investors, activists, etc., I think it's a perception that our only playbook is to encourage companies to buy back stock. In the case of Grid, the management has a very clearly defined 3-year program they announced at the November 24 Capital Markets Day. And what that sees is an extensive augmentation, essentially means increasing the duration of the batteries, and CapEx program, where they intend to build out the capacity from around 1 gigawatt today to 1.7 gigawatts and increase duration from around 1.5-ish hours per battery to 2 hours. And when you look at the way CapEx costs have come down, and when you look at transactions in the market, in our view, that should add quite a lot to NAV. The NAV today is around 117p. We can easily see a conservative scenario where that CapEx program adds maybe 25 to 30p to NAV. And with the shares at a 27 discount today to that spot NAV, we think it's a really good combination of a value and growth story. And when you look at how many transactions there are in a sector that validate the carrying values there, we think it's really something of an each way bet from our point of view. If you get an organic re-rating in the market, so they finish a CapEx program, they'll be generating a very decent amount of excess cash flow per share, then they can buy back shares, pay a dividend perhaps. If that doesn't stimulate an organic re-rating in the shares, it's hard to see them not being subject to some sort of corporate activity.
Right, but the difference here being that there's basically a good business in there, essentially, and it's just been through some specific issues. Just one other thing I was interested in your thoughts on, the recent announcement from the regulator about potential changes to the framework in which renewables generally operate. I'm not talking about battery storage particularly here, but is that potentially a negative for the sector? Because if they do change the goalposts significantly, certainly if they go for option 2 rather than option 1, apart from kicking their own objectives in a painful way, that would also be a big worry for the sector, would it not?
It's obviously when they came out with the news, they were looking at it, it was not ideal, to put it mildly. We do think it would hinder investment in UK renewables, which is not what the government in theory wants. So we'd like to think and hope that the government will be pragmatic, but that might be wishful thinking. What you did see on the day, however, was most of the UK-focused renewables trusts falling around the amount that option 2 would impact NAVs. So we would argue that at this stage, the worst option is pretty much in the price, particularly if you bought on the day when you saw that share price fall. The market did react very strongly on the day when that news came out. So, for example, that was a point at which we topped up on our holding in Bluefield Solar, where we saw the share price fall around the amount that the NAV would go down. I think it's actually a little bit more. And that is the worst case scenario. We think that most likely option 1 will be the one that they go for. We're hopeful that they leave it as is, because we think it would be much better for the UK renewable sector in general. So, it is a headwind and it is an uncertainty, but it's probably in the price now, and you've just got to put a bit of hope and faith in the UK government, which is not always a nice place to be.
Yeah. Well, it's an act of faith, isn't it, to some extent? Let's come back then finally to talking about MIGO Opportunities Trust itself. I'm just looking at the recent performance. 9 months, share price is up 9.6%, according to my data source here, which is nicely in line with your 20% long-term aspirations. You're at 66 million market cap, I think, and you're trading pretty close to par, but not at par, I think. A small discount, 3-4%. Perhaps on that point, just tell me, have you been issuing some shares at any point, or are you hoping to get back to that stage soon?
Sadly, we haven't been issuing any shares recently. I think the last issuance we did was in 2021. We have, like much of the sector, been more on the buybacks than the issuance. It's very helpful when we go into boards and say buybacks are accretive to NAV and help keep your discount tight, that we do put our money where our mouth is. We do believe that our investors should enjoy the value in our underlying portfolio, but we don't like our investors taking too much discount risk at a MIGO level. So we trade reasonably close to NAV, and we think that's important. We do have also a 3-year realization opportunity, which the last one was last year. Again, that helps A, with liquidity, and B, to keep that discount in. And we think that, performance has been very passable, very decent for the last 6 months, but we think that discounts are still incredibly wide, and there's some interesting corporate opportunities down the road, and hopefully that should help drive performance going forward as well.
So the case you would make for why people should look at this would be you've got room to grow the NAV, obviously, in your target, within your threshold, and you're going to hope to keep the discount if you use one pretty small. You just need to make those opportunities come through, right? The 20% aspirational return would be very nice to make it. How much confidence can you give us that that's going to be achievable? Now, I'm not expecting you to say it's not achievable, but give us some comfort around the aspiration.
I think what we'd say is that we're never going to promise anyone a return, but what we can say is we've both been looking at the closed-end fund sector for a long time, myself even longer than Charlotte. I can certainly say that it's the best opportunity that I can ever recall seeing. And what you have here are 2 managers who, for better or worse, live, sleep, eat and breathe investment trusts. It's a sector that we know very, very well, and we think we are particularly well placed to make hay from it.
Very good. So on that note, I think that brings us to an end. It's been a very interesting discussion. I'm sure listeners will be very interested in both the trust and some of the specifics you've covered. So thank you very much for joining me for this podcast. That's been Tom Treanor and Charlotte Cuthbertson, co-managers of MIGO Opportunities Trust, ticker MIGO.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.